The case for the XRP ledger in an RWA-Centric, quantum-resistant financial future. Executive Summary, written by Denarii. The global financial system is on the cusp of a foundational architectural shift, driven by the convergence of institutional demand for efficiency and the maturation of distributed ledger technology, DLT. While the concept of a quantum financial system, QFS, remains a theoretical framework, its core principles, unprecedented security, asset-backed value, transparent settlement, and near-instantaneous efficiency, are being actively pursued and implemented through the tokenization of real-world assets, RWAs. This market-led transformation, spearheaded by financial titans such as BlackRock and JP Morgan, is rapidly moving from experimentation to large-scale production, creating a multi-trillion-dollar opportunity to replatform global capital markets. This report posits that the XRP ledger, XRPL, is uniquely positioned to serve as a foundational settlement and liquidity layer within this emergent financial system. Its technical architecture, characterized by high throughput, low transaction costs, and rapid settlement finality, was purpose-built for the demands of institutional finance. Native protocol features, including an integrated decentralized exchange, DEX, and advanced payment primitives, provide a secure and efficient environment for managing tokenized assets without the complexities and vulnerabilities of more generalized blockchain platforms. Crucially, the recent activation of the Credentials Amendment on the XRPL introduces a native, privacy-preserving identity and compliance layer. This solves a critical barrier to institutional adoption by enabling on-chain KYC AML controls, allowing regulated entities to operate within a decentralized framework. This strategic focus on compliance, combined with a clear roadmap for institutional DeFi and a crypto-agile design capable of adopting post-quantum cryptography, directly aligns the XRPL with the requirements of the next-generation financial system. The validation of the XRPL ecosystem through strategic integrations, such as the use of Ripple's RLUSD stablecoin as a 24/7 liquidity off-ramp for BlackRock's BUIDL fund, provides tangible evidence of its growing role. The case for the XRPL is not predicated on a hypothetical future, but on its demonstrable capacity to meet the real-world demands of the tokenized economy being built today. Section 1. The Architectural Blueprint of Next-Generation Finance. The trajectory of global finance is being redefined by two powerful, interconnected paradigms. The first, the quantum financial system, QFS, represents a theoretical ideal for a future financial infrastructure. The second, the tokenization of real-world assets, RWAs, is the pragmatic, market-driven force that is actively building this new system. Understanding the distinction and synergy between these concepts is essential to identifying the technological infrastructure best suited to support the future of capital markets. 1.1. The Quantum Financial System, QFS, a theoretical framework for a new financial order. The quantum financial system is a hypothetical construct for a global financial network that leverages quantum computing, advanced cryptography, and blockchain technology to manage transactions and data. It is conceptualized as a replacement for legacy systems like SWIFT, designed to deliver unparalleled security, efficiency, and transparency. While its implementation remains theoretical, its core principles serve as a comprehensive set of requirements for a future-proof financial architecture. 3. Quantum security. The foundational layer of the QFS is its proposed use of quantum computing principles to create a virtually impenetrable shield against hacking and fraud. This involves leveraging quantum phenomena like superposition, where quantum bits, qubits, can exist in multiple states simultaneously, to perform calculations at speeds exponentially faster than classical computers. This processing power would be applied to complex algorithms for fraud detection and market analysis. Security would be further enhanced by quantum key distribution, QKD, a cryptographic technique that makes it physically impossible for data to be intercepted without the sender and receiver being alerted, thus protecting against threats from both classical and future quantum computers. 3. Decentralization and transparency. Unlike the current financial system, which relies on centralized institutions, the QFS is envisioned to operate on a decentralized, tamper-proof platform. By integrating a digital ledger or blockchain, every transaction would be permanently recorded and auditable, reducing the influence of central authorities, mitigating corruption risks, and providing global transparency for regulatory bodies and stakeholders. 2. Asset-backed currency. A cornerstone of the QFS concept is a departure from the fiat monetary system. It proposes the use of digital currencies backed by tangible assets such as gold, silver, or other commodities. This model aims to create a more stable and equitable financial environment by tying the value of currency to physical assets, thereby reducing the risks of inflation and devaluation associated with central bank policies. Each unit of digital currency would have a verifiable link to a reserved asset, ensuring intrinsic value. 1. Efficiency and scalability. The immense computational power of quantum computing would enable the QFS to process transactions in near real time, eliminating the delays common in cross-border payments. The system is designed to be highly scalable, capable of handling massive transaction volumes without compromising performance. This efficiency extends to automation through the use of smart contracts for executing payments, loans, and compliance checks, further reducing reliance on intermediaries and their associated costs. 2. It is essential to recognize that the QFS, in its complete form, is a conceptual framework rather than an active, deployable system. Its value in this analysis is not as a forthcoming product, but as a benchmark, a set of ideal specifications against which existing and emerging technologies can be measured. 1.2. The tokenization of everything, real-world assets, RWAs, as the new capital market. While the QFS remains theoretical, its core principles are being actively implemented through a tangible and rapidly expanding market, the tokenization of real-world assets. RWA tokenization is the process of creating a digital representation, or token, on a blockchain that corresponds to ownership of a physical or traditional financial asset. 6. This innovation effectively builds a bridge between traditional finance, TradFi, and the technological efficiencies of decentralized finance, DeFi, and it is being driven by the world's largest financial institutions. 8. Market size and institutional validation. The potential market for RWA tokenization is immense, with projections suggesting it could encompass hundreds of trillions of dollars in assets. 9. The Boston Consulting Group estimated that the market for tokenized illiquid assets alone could reach $16.1 trillion by 2030. This is not a speculative forecast, but a trend validated by the actions of industry leaders. BlackRock CEO Larry Fink has publicly stated that tokenization represents the technological transformation for financial assets, signaling a strategic shift by the world's largest asset manager. The first scaled RWA market emerged with fiat-backed stablecoins, which now exceed $150 billion in value. More recently, the market for tokenized U.S. Treasuries has exploded, growing from approximately $100 million in early 2023 to over $6.5 billion, led by offerings from giants like BlackRock and Franklin Templeton. 11 key benefits driving adoption. The institutional rush into RWA tokenization is motivated by a clear set of economic and operational advantages that address long-standing inefficiencies in capital markets. Enhanced liquidity. Tokenization can convert traditionally illiquid assets, such as real estate, private equity, fine art, and intellectual property, into tradable digital instruments that can be exchanged on 24/7 global platforms, unlocking vast amounts of previously static capital. Fractionalization and accessibility. By dividing a high-value asset into numerous smaller digital tokens, tokenization dramatically lowers the barrier to entry for investors. This allows individuals to own a fraction of a commercial property or a rare piece of art, democratizing access to asset classes previously reserved for institutional or high-net-worth individuals. 7. Operational efficiency and cost reduction. Blockchain technology consolidates the processes of distribution, trading, clearing, settlement, and custody into a single, unified layer. This eliminates many of the intermediaries required in traditional finance, reducing operational costs and complexity. Furthermore, smart contracts can automate corporate actions and compliance checks, while settlement times can be reduced from days to mere seconds, significantly decreasing counterparty and settlement risk. Transparency and auditability. Every transaction and change of ownership is recorded on an immutable, distributed ledger, creating a transparent and easily auditable golden source of truth. This enhances trust and simplifies regulatory reporting. The convergence of these trends reveals a profound insight into the future of finance. The QFS should not be viewed as a future event to be awaited, but rather as a set of design principles for an ideal financial system. The RWA movement, driven by institutional capital and the pursuit of tangible efficiencies, is the practical, market-led implementation of those very principles. The QFS's call for asset-backed currency is being answered by the tokenization of real, value-producing assets like U.S. Treasuries and real estate. Its demand for security and transparency is met by the immutable and auditable nature of blockchain ledgers. Its vision of speed and efficiency is the core value proposition of RWA tokenization, which aims to replace archaic multi-day settlement cycles with near-instant finality. Consequently, the coming financial system is not a distant quantum phenomenon. It is being constructed today, asset by asset, on distributed ledgers. This paradigm shift also marks a crucial evolution in the narrative from speculative crypto towards the use of DLTA as a superior technological rail for managing and trading regulated traditional financial value. The actions of major institutions are not an endorsement of cryptocurrency speculation, but a recognition of blockchain as a more efficient infrastructure for their core business. This implies that the DLT platforms best positioned to succeed will be those that can meet the stringent requirements of regulated institutional finance. Section 2. Institutional Forerunners, Building the On-Chain Financial System. The theoretical potential of RWA tokenization is being rapidly converted into practical reality by the world's leading financial institutions. Their large-scale initiatives are not mere experiments, but the deliberate construction of a new market infrastructure. Analyzing the actions of BlackRock and JP Morgan provides a clear blueprint of the essential components and requirements for this on-chain financial system. 2.1. BlackRock's BUIDL Fund, a case study in tokenized market dominance. BlackRock's entry into the RWA space has served as a powerful catalyst, demonstrating the immense institutional appetite for tokenized products and setting a new standard for the market. Fund Overview and Architecture. Launched in March 2024, the BlackRock USD Institutional Digital Liquidity Fund, BUIDL, is a tokenized money market fund issued on the Ethereum blockchain through the Securitized platform. The fund is exclusively for qualified investors who have passed KYC AML checks and invests its assets in cash, U.S. Treasury bills, and repurchase agreements. 10. Each BUIDL token is designed to maintain a stable value of $1, with daily accrued dividends paid out to token holders monthly via an on-chain airdrop, allowing investors to earn a yield directly within the blockchain ecosystem. 10. Unprecedented growth and market impact. The launch of BUIDL was met with immediate and overwhelming demand. The fund quickly attracted over $460 million and surpassed $1 billion in assets under management within its first year, establishing itself as the largest tokenized fund in existence. 10. This rapid growth single-handedly drove a significant expansion of the entire tokenized treasury market, validating the thesis that institutions are ready and willing to adopt DLT-based financial instruments when offered by a trusted, regulated entity. 11. Strategic integration with Ripple's RLUSD. A pivotal development occurred in late 2025 when a new smart contract mechanism was introduced, allowing institutional holders of BUIDL to seamlessly exchange their tokenized shares for Ripple's RLUSD stablecoin. This integration provides a crucial 24/7 liquidity off-ramp, enabling investors to move out of their BUIDL positions and into a stable, transferable digital dollar at any time, bypassing the constraints of traditional banking hours. This partnership not only enhances the utility and liquidity of the BUIDL fund, but also serves as a landmark validation of Ripple's stablecoin and the broader Xrpl ecosystem as a credible settlement layer for institutional-grade RWAs, 42.2 JP Morgan's Connexes, building the rails for institutional DeFi. While BlackRock is focused on creating a flagship tokenized product, JP Morgan has been building the underlying infrastructure, the rails, settlement systems, and interoperability solutions necessary for a scalable on-chain financial system. Platform scale and strategic vision. Kinexys, the rebranded blockchain business unit formerly known as Onyx, is a mature production-grade platform. It is not a research project, but a core part of JP Morgan's financial services offering, having already processed over $1.5 trillion in notional transaction value, with current daily volumes exceeding $2 billion. The rebranding to Kinexys, derived from kinetic and connection, signals the platform's focus on accelerating the movement of money and assets and connecting disparate financial ecosystems. 16. Core services and RWA focus. Kinexys provides a suite of DLT-based services designed for its institutional and corporate clients, including Siemens, Ant International, and BlackRock. 16 key offerings include Kinexys Digital Payments, a programmable, near real-time 24/7 payment rail for multi-currency transactions, which is being integrated with JP Morgan's FX services to enable on-chain foreign exchange settlement. 16 Kinexys Digital Assets, a multi-asset tokenization platform that is home to the Tokenized Collateral Network, TCN. The TCN is a groundbreaking application that allows clients to tokenize traditional assets, such as shares in money market funds, and use them as on-chain collateral. 18. This unlocks liquidity from previously static assets and enables near instantaneous atomic settlement for complex transactions like intraday repurchase, repo agreements, of which over $300 billion have been processed on the network. 21. Interoperability and industry collaboration. A central theme of the Kinexys strategy is solving the problem of blockchain fragmentation. JP Morgan has been a key participant in the Monetary Authority of Singapore's Project Guardian, a collaborative initiative to explore the future of financial infrastructure. In a landmark proof of concept, Kinexys, in partnership with RWA platform Ondo Finance and Oracle provider Chainlink, successfully executed a cross-chain atomic settlement. This test involved the transfer of tokenized U.S. Treasuries from Ondo's public testnet to Kinexys's permissioned payment network, with simultaneous payment occurring in the opposite direction. This demonstrated a viable model for connecting siloed public and private ledgers, a critical step for building a unified digital asset ecosystem. The concrete actions of these financial titans reveal the architectural requirements of the emerging on-chain financial system. It is not enough to simply create a tokenized asset. The BlackRock BUIDL fund, while immensely valuable, saw its utility significantly enhanced by its integration with Ripple's RLUSD stablecoin, which provided the 24/7 settlement layer it needed. Similarly, JP Morgan's focus is not just on tokenizing collateral, but on making that collateral mobile across different networks. This points to a required liquidity triad. 1. High-value tokenized RWAs. 2. A liquid and compliant stablecoin for payment and settlement. And 3. A robust interoperability protocol to connect them. Furthermore, the institutional model is not one of public chain maximalism, but a hybrid approach. The Kinexys Ondo transaction exemplifies this, with assets moving from a public environment to a controlled permissioned network for settlement. The critical question for the future of finance is not private versus public chains, but rather, how can we securely and compliantly connect private and public ledgers? Section 3, the XRP ledger, an analysis of institutional-grade infrastructure. To serve the emerging RWA-centric financial system, a distributed ledger must offer more than just the ability to create a token. It must provide institutional-grade performance, native financial functionality, and a robust framework for regulatory compliance. A deep analysis of the XRP ledger's core architecture, built-in features, and strategic roadmap reveals a platform that appears to have been deliberately designed to meet these specific, demanding requirements. 3.1 Core Protocol Attributes, built for finance. The XRP ledger's fundamental design choices prioritize the speed, efficiency, and scalability necessary for global financial operations, setting it apart from many first-generation blockchains. Performance metrics. The XRPL is engineered for high performance, capable of processing up to 1,500 transactions per second TPS own its base layer, with the potential to scale to tens of thousands of TPS using off-ledger solutions like payment channels. Critically, it achieves transaction finality in 3 to 5 seconds, meaning a transaction is irreversibly confirmed in less time than it takes to process a credit card payment. 26. Cost effectiveness. Transactions on the Xrpl are exceptionally inexpensive, with fees typically costing fractions of a cent. Instead of a variable gas fee paid to miners, the ledger requires a minuscule amount of its native asset, XRP, to be burned with each transaction. This mechanism prevents network spam while keeping costs predictable and low, a crucial feature for institutions that may need to process millions of transactions. 25. Consensus mechanism. The ledger employs a unique consensus protocol, often referred to as federated consensus, which does not rely on energy-intensive proof-of-work mining. Instead, a distributed network of independent validator nodes must reach a supermajority agreement, over 80%, on the validity and order of transactions to close a new ledger. These validators are chosen based on their reliability and performance, forming a unique node list, UNL. This model provides fast, efficient, and decentralized consensus, achieving high performance without the environmental or economic drawbacks of traditional mining.